welcome. The budget was the biggest event this week, and we've of course moved on from that. But we are trying to decipher what this means for secondary markets, private markets, and to help us understand that better, we have with us two stalwarts from the industry, Gopal Jain of Gaja Capital and Rahul Basin of Bearings Capital. Thank you very much, gentlemen. It's indeed a pleasure to have both of you help us understand what this budget means for investors, private investors in particular. Gopal, I'll start with you. There were headlines the day after the budget would call this a dream budget for private investors on back of tax parity. You want to comment on that? You want to tell me what stood out for you and what does this mean for your industry?
Yeah, thank you so much. I'll make my comments in two parts. Indeed, there were measures in this budget that have been expected for the longest of times. And I think the two principal measures on the tax side are angel tax and capital gains tax rationalization. You know, angel tax, the removal of angel tax has been a demand for the longest time. It interferes with capital formation. Maybe it was done for the right reasons, but it's ended up being counterproductive. Similarly, parity between listed and unlisted was a demand from the industry for a long time. And both these measures will go a long way in helping scale up the industry and reducing and increasing the ease of doing business. But more than that, and maybe we can have a separate chat about this, is the general direction of this budget. You know, there were concerns about policy continuity and stability. And we're all so glad to know that fiscal stability continues to be the central pillar of this budget. And the biggest beneficiary of fiscal stability is the private sector, entrepreneurs, investors. So, you know, in both parts, which is tax measures and the core content of the budget, this budget has been extremely positive.
Well, that's a clear thumbs up. Rahul, what about you? What are your thoughts on the removal of the angel tax and how will this impact startups?
Look, you know, if you look at anybody in my industry, it actually tantamounts to a severe reduction in harassment of very young companies. And therefore, you know, I have to say that it's very favorable. But if one looks at it from the country's perspective, I think this brings to light a really stark issue, which has been, you know, hounding us for a long time. And that is the inability of the government ecosystem to nuance things. The reasons why this angel tax was introduced in the first place was to prevent, you know, a mechanism of bribery or money laundering, which was essentially to float a private company, have a nominal capital, and somebody who wanted to pay a bribe to someone could then invest at a ridiculous valuation into that company for a token stake. And therefore, effectively, you passed on economic means, right? Now, that was the sort of thought process when this was introduced. And if it had been applied to actually curb that misuse, I don't think there was anything wrong with that law. But the actual application on the ground was to harass the entire ecosystem of startups. And so what have we done? Now we've gone back to the regime of not having this. So the original intent has been lost. And, you know, really, this was simply about framing proper rules and guidelines for the tax officials so that they did not misuse what the intent of the law was. So I think this is a sort of broader issue for the economy and our governance architecture as a whole. But I have, from my own personal selfish perspective, I have to say that it's a very welcome step.
Well, it's good to be selfish, isn't it, Rahul? Rahul, let's talk about the funding window. And we've heard this term used so often in the last couple of years. We went from easy money to a funding winter pretty swiftly, right? Do you feel like that's now coming to an end? Because money is on the sidelines. A lot of the money that was going into China was supposed to find its way back into countries like India and Japan. From where you sit, do you feel like this funding winter could be finally coming to an end?
You know, I think that you said it when you said that easy money followed by funding winter. I think that's the natural cycle of markets, right? So if you have excesses in any part of the economy or the ecosystem or the funding ecosystem, you will then have a correction. And that's all it was. I think we read too much into it. I think several companies got funded which should have never got funded. certain valuations got overextended, and when you go away from economic rationality, right? What is the revenue of this business? Which customer does it impact? What is the free cash flow it generates? And therefore, what might be the value of that business? And you start using all kinds of artificially created metrics and new terminology in finance. Usually, you're setting yourself for a funding winter, and I think that's so. I would really look at it as a cleansing process rather than any sort of fundamental change in the availability of capital or a rational clearing of markets. It was just literally a correction of excesses.
Going to take a cue from that and ask Gopal the same question. Gopal, do you feel like the cleansing process is now coming to an end? Because there is indications that money is available. Now money is finding its way, a lot of it into secondary markets. Very unlike what we've seen in the last few, just before the last 2 years. Do you feel like this process is now beginning to reverse?
As you said, there's enough money on the sidelines. So why weren't deals happening? Deals weren't happening because of a valuation mismatch, and deals weren't happening because of a mismatch between expectations on where businesses need to be in terms of business model maturity. In the last 3 years, there's been good companies have progressed on both these fronts. They've grown revenues, and many companies have actually progressed on the curve of maturity, improving their financial economics, their business economics, and therefore the gap between what investors are prepared to pay and what companies are prepared to accept, I think, has reduced, which is why you see a pickup in investing. Cleansing is a natural process in the markets. This is capitalism 1.0. Every few years, there'll be a lot of startups created, but only a few of them will move to the next level. And who will move to the next level? The ones with the best and the most efficient metrics, right? As opposed to what Rahul said, a focus on vanity metrics. Talking about public markets, again, this is cyclical. Yes, indeed, public markets are attracting money. But listen, these two markets don't exist in vacuum. One exists for the other exists for the first. What is private today becomes public tomorrow. And because public markets are doing so well, we are seeing a huge increase in exits. Exits are important for private markets, right? For the longest time, the issue in India was lack of exits. So these are all tied up together. And as long as they happen in moderation and things don't go crazy, this thing can sustain for a long time.
Good point, because some may argue that while this is great for an exit, it's impacted entry as well, because secondary markets have also been phenomenal in the last couple of years. Pretty much and at the same time as private markets have struggled just a bit. Well, let's talk about this, Rahul. Has the funding winter impacted your deployment schedule? What were the changes you made in 22, 23, and what are you changing now going ahead? Has that deployment changed? Is it picking up?
I think on the contrary, you have when you have excesses, you have to be cautious. But when the market's very cautious, it's the right time to be a little bit more aggressive. And I think that our deployment rate in the last 12, 18 months has been the highest it's been in the last 26 years.
Highest it's been in 26 years?
That's right.
Wow. Gopal, do you share the same emotion? Do you feel like that's exactly what's happening with you as well and with Gaja?
We've had to work harder. We operate purely in private markets. And in private markets, price discovery is a more difficult process. Good companies are well funded. They have strong investors in their cap tables. So what we've had to do in the last 2 years is work a lot harder, focus more on coverage, focus more on proprietary development, intermediated deals. It's been hard to close intermediated deals.
It has. Okay, that's good to understand of how things are so different, right? And it's so specific from one player to another. But formation of the variable capital company, and I want to talk about this with what we heard at the budget, is now being permitted in India. Gopal, help our viewers understand what this means. Of course, most viewers would be tuning into this conversation would already be well versed with a lot of it. But what are your thoughts on it? How will this change the landscape of investing, both for fundraising and the flexibility of investments?
This is a good step in the right direction, but listen, it's a complexity that investors have to understand. what it does is it allows fund managers, it obviates the need to create separate vehicles for different sets of investors. You can have one structure in which you have, let's say, a whole list of assets, and you have a significant amount of discretion as to how you allocate beneficial interest to each investor. Also makes it easier for investors to enter and exit, right? I would urge investors to take their time, understand the structure well, but yes, this is a win-win for both investors and managers.
Right. Rahul, your thoughts on this? This is a big, significant move in the right direction. What is the impact, and how soon will we start feeling it, or the industry will start sensing it?
Look, I concur on the intent, and I concur on the flexibility which is being attempted to be offered. But like in all things in India, you have to see the fine print, and you have to see how the officers on the ground execute, implement it, and what rules they frame. I mean, I think that I would actually wait and see how that plays out, because very often these things at the policy level, when they're framed in intent is something, but when it actually gets articulated and implemented on the ground, something else transpires. And so I would just like to be a little cautious and wait and see how it pans out and how it plays out and how it gets interpreted before I take any bold moves in that direction of utilizing this flexibility.
You're right. A lot of this is so much intent, right? Even on the employment front, the Viksit Bharat story, it's going to be very important to see how well and how this gets executed. And I think the success will be determined by just that. Gopal, I don't know whether this is a space that you track or private equity is an interest, but I'm going to ask both of you this any which ways. With indexation giving away in real estate, and of course, the rate of taxation has been dropped down, what happens to allocations that have been made by PVC firms in this space? Is this even going to impact your industry?
I'll happy to go first. I think first of all, it's both a give and take, right? It's not just a take. Indexation has been given away, but the rate of taxation has come down, right? I think let's wait and see how this impacts investments, because it works both ways. There are other positives as well. For example, Forex now is a pass-through, which means for foreign investors, their capital gains will be measured on, on the basis of where the conversion is, as opposed to in rupees. So, I think we should wait, as Rahul said, for things to settle, for investors to take a call. Ultimately, unless and until taxation is usurious, which it is not in this case, it is really the underlying behavior of the asset class which decides whether capital comes in and at the desired pace. And I think there we are in a good place. The real estate cycle is in a good place. The Indian economy is in a good place. I think most of the other things will take care of themselves.
Rahul, you want to comment on this one?
Yeah, look, I think that as far as real estate goes, it's, as far as this tax thing change takes place, I really don't think it makes much difference either way, because you remove indexation, reduce the absolute tax rate, it's not going to matter that much. I mean, and in fact, if you assume, looking at fiscal consolidation, and you assume that inflation is likely to be in fact lower rather than higher going forward, then I think that this might actually benefit the taxpayer rather than the other way around. But I think what's very important in the real estate space is to understand one very basic feature, and that is the fact that in India, very often real estate prices reflected shortages and not necessarily value. And in a lot of urban conglomerations, and that was because, again, as a society, we did not create adequate urban capacity. Every country which, when it grows richer, has a migration from rural to urban. And in that context, you have to create urban capacity to be prepared for it. You cannot have a multi-story building unless you have roads, provisions for water, provisions for drainage, provisions for solid waste management, garbage collection, public transport, public utilities. So that whole architecture needs to be created. And because of a shortage of that, there's been a shortage of urban space, and therefore you've had extraordinarily high prices. Now, be that may as it may, the reality is that in the last 10 odd years, you've not had much of a sort of boom in real estate prices. So therefore, I don't see much downside. But as urban infrastructure kicks in and supply increases, you might not have that tearaway bull market, except in maybe certain localized geographies that you've seen in the past in these markets. But the taxation rationalization per se, I think is a good thing, and it sort of it actually simplifies implementation and execution, and I sort of think it's a step in the right direction for sure.
A couple of things, Gopal, and I'll start with you on this because I know that you have a specialization in the education space and skilling, and that's the kind of area you not only enjoy but also invest in. The budget's biggest theme this time was improving employability, skillability, and the fact that that is going to be the big push and will help India get to that $5 trillion economy in the next 5 to 10 years. With this push to skilling employment in the country, how do you feel about the sector? Do you feel like this was what was required, the need of the hour? And do you now go back to the drawing room and make more aggressive bets in this sector, given the change in policy or attitude, at least, of the government towards the space?
Two biggest issues with labor in India, or two of the biggest issues in labor in India is one is we know this 1 out of 2 graduates is unemployable. Skills are an issue. We have education but lack of skills, and in some ways you could say, well, that's a reflection on education itself. And the second is this whole thing about formal and informal employment. There is a huge incentive for employment to stay informal. I think this budget addresses both these issues, right? Skilling. There's a renewed focus on skilling. This time there's an attempt to make the private sector a partner. The previous apprenticeship scheme was a success and it builds on that. And the second is subsidizing employers in terms of the deductions. India has one of the highest entry-level salary deductions in the world. Chitti wali salary is a liability for most employees. So reducing those frictions by currently giving a subsidy, maybe down the line we can think of other measures, are measures in the right direction. Yes, there have been a lot of attempts around skills and around building businesses and skills. Not enough have succeeded, but with this renewed focus going forward, this time around, things could be different.
I'm just going to spend some time on the industry dynamics right now. And Rahul, I'll start with you. Given the governance issues that we saw with certain startups, and Byju's case in point, has it impacted the due diligence that you now undertake when you identify a company for investing? And what are the learnings that you would like to share with entrepreneurs who are watching us right now to understand what one should be doing? Because intent was not a problem for the likes of a Byju.
The kind of issues that come up with people like the Byju's incident, etc. It's very sad, but if you look at what played out in Byju's case, and you look at what played out in Educom's case, which preceded them by about 10 odd years, you would find very similar issues. So to my mind, actually looking at past failures and trying to understand what happened and how those transpired is, I think, incumbent upon both the managements of these businesses as well as investors. And the fact that both were oblivious to the same kind of issues having played out a decade earlier and gone headlong into a space and, with a strategy and a sort of execution focus, which was almost exactly replicating something which ended in a disaster. I think, it really says that as an industry and as entrepreneurs, we really need to be far more professional and diligent and thorough in how we do our work. And it's not very complicated as far as that is concerned. Two, it's very sad to see that, a very significant part of, whenever there has been any misreporting or any kind of serious deviation of actual numbers from what's being reported, etc. What disturbs me a lot actually is that if you look at the last decade or so, in most of these high profile cases, you've actually had very reputed auditors. So either, people are becoming smarter and this is a sort of an arms race kind of thing playing out, or I think that, there probably needs to be better oversight and, in the audit community too, because ultimately, most investors will rely on numbers that they are shown, and they get some degree of comfort saying that there's a maker and there's a checker, and the checker is the auditor. So I guess if that system breaks down, it becomes a little difficult. So in Baiju's case, though, I personally believe that there were enough signs for enough time. And like I said, this is an issue which has played out before. But there have been many companies. This is not new. This is not unique. And if you look at the Indian corporate sector, I think one of the big challenges is that, the government has had a very strong mindset in India that if any bank loans are lost, this is actually something which needs to be investigated, and people do a very thorough job of it. But when equity money gets lost, right? If you look at it from a regulatory perspective, several times there are actually very strong breach of fiduciary trust which is taking place. The company law board, etc., I think does not have the capacity to investigate or hold people accountable, and therefore you keep seeing these repeats. I think that's a very necessary part of our capitalistic ecosystem, where stealing from a business or diverting capital from a business or misrepresenting to all your stakeholders very deliberately, I think there have to be consequences. But if you look at it, there really hasn't been. If you steal money from a bank or that same thing happens from bank finance, there is an entire architecture in place. Some may argue that it's on the margin excessive, but it's not there as far as equity is concerned. And I think equity is as real an asset class and needs that same degree of protection.
I completely agree. And I think while this has happened in the past, Baiju's made headlines a lot more because it's been in the public domain and, of course, got the attention of more people than most others. Very lastly, Gopal, before we wrap this conversation up, and, please share your thoughts on this, right? Are you seeing a lot of, we are seeing a lot of push been given to GIFT City in the last year at least. Any growth in investor interest through the structured domestic or offshore? Just your thoughts on what that's looking like and how it's coming along.
Yes, there's been a lot of progress on GIFT City. Every large economy has its own offshore center. And so we can't rely on other offshore centers for pooling, for funds to find a domicile. I think the next step in GIFT City's evolution is to extend it to Bombay. That will scale up IFSC at 10x. And we are hoping that the government will look at that favorably. The authority is positive, it's interactive, it listens to the industry, and there are a lot of suggestions made over the years that have been accepted. So I do see growth going forward, and I do see an opportunity for this growth to be turbocharged if GIFT City is moved to Bombay. It's extended to Bombay.
Right. One last question before I have to let both of you go. Rahul, are you seeing an increased interest in co-investments, or do investors majorly prefer the fund route?
Look, it's a cyclical thing. In boom markets, everybody wants to do co-investments because it looks as if there's easy money on the table. And in bear markets, people want to run away from that sort of ecosystem and asset class. Institutional investors, I think, have gone through a sort of process where they feel that they will save out on costs if they do more co-investments. So I think that's a structural trend. But I see a lot of it with individuals and family offices too. But I feel personally that's a bull market phenomenon. When the markets turn, I think you will see people sort of retreating from it a lot. And if you don't mind, I'll comment on something that you discussed about the employment schemes, etc. To me, I think that's a very, very positive step, not because it's necessary that these schemes will necessarily work, but much more that the government has put its mind to addressing this problem and have come up with a whole bunch of schemes. And if you look at the track record and the thinking of the government that I've seen in the last decade or so, when they put their mind to something, they keep on iterating and keep trying new things till they get it to work. To my mind, one of the reasons why we are not seeing a lot more employment is that you have to fix that entire value chain as to why is it that businesses in labor-intensive industries are not setting up and not being able to compete globally. And I think that if you look at the Chinese model, where the Chinese government effectively offered land at 20, 30, 40 years for free on a free lease, invested in that infrastructure, invested in housing capacity for the labor to work in those labor intensive industries, and then invited private sector participation. I think if our government were to just take a leaf from their book and create clusters for labor intensive industries, I think you might see all these schemes be a lot more successful going forward.
Right. Thank you, Gopal. Thank you, Rahul. Great having both of you on the show. Have a good weekend, and we'll hopefully see you soon. Thank you very much.